Hi, everyone. Welcome back to the show. I took a little break here, but we are back, and we have a very special guest with us today. His name is Tom Liston. Tom is an analyst turned founder of his own family office, Water Street Capital. Tom is on the boards of Well Health Technologies, of which I'm a shareholder, and Tantalus Systems, as well as other public and private companies. Tom, welcome.
Robin, thanks so much for having me.
So, Tom, you were born and raised in New Brunswick, and then you made the big move to Toronto and Bay Street. What was that journey like, breaking through into the big world of Toronto and Bay Street?
Yeah, it certainly wasn't an easy and a clean path to get to Bay Street from New Brunswick, and I've always wanted to be in finance. I kind of grew up in the days of Frank Mersch and Veronica Hirsch when they were on billboards and kind of became rock stars. That was the era of when mutual funds really started to take off and advertise aggressively, and I knew I either wanted to pick stocks or give advice on stock picking. So I did my CSC even in university. I started my CFA a bit early, and just that was a single focus. Now I graduated from University of Brunswick, which I'm very proud of, but the network on Bay Street isn't high. There was about one person that I really knew that I could maybe leverage. And did pretty well with interviews with like RBC and what have you, but they sort of said, "Hey, we have a bunch of graduates from Queens and McGill, and we love you, but don't know if we want to fly you up to Toronto." So I did do a master's in economics in Queens, which was obviously very helpful anyway. And honestly, the first week I was at Queens, all of a sudden CIBC and these others wanted to interview me and had lots of interest, even though I was the same student a few months before. But that's well, the connections are important, obviously. But I did not have, normally someone has an uncle or some other alumni that's kind of close that kind of helps you in the door. And what I actually did was I wrote my master's thesis on valuation, on if low PEs work in the TSX environment, and taking into account transaction costs, survivorship bias, all these other things that no other study had taken account of. So I was, end up being published in some of the Canadian finance books with this evaluation report. I did a new profile on risk assessment as well. And so I published that thesis, and I wrote a research report on a company, probably not a very good one, but did manage to get a hold of the CFO and just did some extra work. So when I sent my resume and things in, it looked a little different than probably everybody else's. So a lot of folks were interested in Bay Street partly because of the pay, and I clearly said this is the only job that I want. I don't want to be a strategy consultant. I don't want to be whatever else. Like, this is the job I want. So thankfully, the market's improved and what have you when I graduated, and I ended up getting, I think, 4 offers, from struggling to getting 4 offers, and then took a job at Yorkton, which was at the time Canada's leading technology investment bank, which was fantastic place to start my career.
Well, tell us about Yorkton. Tell us about that
Yeah,
experience
there's
and
some
what you learned.
look. The short answer is two things. They did almost every deal that they could, and that was probably the challenge. The good part was, though, we were competing with the biggest deals in Canada, like where it was Cognos or CGI. Like, we were a household name with CIBC and some of the other big banks. So we punched way above our weight in tech, and some of the same folks that I work with continue to be awesome Bay Street vets to this day, and some of the best in class, whether it's sales, research, or what have you. We had a team of 7, I think, research analysts at one point in technology alone, right? And Canada's not the biggest technology hotbed. Now, that was 1999, 2000, where there was a lot going on. But the good news was I got to see companies from 10 million market cap to multi-billion, and we were in the throes of dealing with all of them, whether it was marketing, trading, financing, all the above. So it was a great way to start. We did. I've always wanted to do technology. I think coming from New Brunswick, I might have picked forestry or something in natural resources potentially, but really loved, and especially software. I was super attracted to covering mainly software or recurring revenue streams for a bunch of reasons. It helped me sleep a little bit more at night because they were a little bit more likely to make their quarters, or at least a little easier to forecast. But I just thought, there were many of them were producing such great cash flows that people probably at the time misunderstood a bit. Although when it came into the market, it was 1999, and we were basically pricing everything off revenue.
Yep.
which was probably a little counter to my valuation thesis coming out of Queens. But eventually, obviously, some of the powers of the cash flow model. We'll probably talk about Constellation, but it took the street, because they're so comfortable with resources in Canada. It took the street a while to realize how powerful these economic models were in technology. So thankfully, I got in the right time, sort of the front end of that wave.
Absolutely. So you found success as an analyst at Yorkton. Then you moved on to Versant Partners as director of research. And is it true that were you the first or the second or the third to actually cover Constellation software?
Pretty sure. So BMO, I think it was BMO that took them public. One of the banks, of course, and I think Jason Donville just speaking about this. But teachers, I mean, forced might be a bad word, but I think it was pretty forced to take them public. And Mark Leonard, and I know him quite well, fortunately, and he did not want to be a public company. And the interesting piece about that is, I think Jason mentioned this. There wasn't a lot of trade in the stock, and for a boutique, we shouldn't have covered that company. Like, the economic model for us, they were never going to finance, right? But for me, I made it pretty easy. I just wanted to pick the best companies to follow, and then I figured, as long as they were going up and to the right, eventually someone would finance, or M&A, or eventually the trade would come. And in the case of Constellation, it came a little sooner rather than later. But at some point, teachers probably had to sell some. And I just wanted to be involved with the best companies and get to know the best management teams. And even though day-to-day trading and Constellation did not pay our bills at the trading desk or as a firm, I just felt if you followed the 10 or 12 best technology companies that you could find, the accounts would trust you. And then over time, if you played the long game, you'd make enough money along the way. Whether it's financing or eventually trading big blocks of secondary market, all that type of thing. So I thought that reputation and would lead the way, and then the earnings power and the economics would follow.
Yeah, and then if viewers on the show go on your LinkedIn and have a look at your resume, you did a whole lot of work in equity research. Then all of a sudden, you're an early investor and board member of QHR, a company that was taken up by Loblaw. What happens in between? There's a whole lot that goes into bridging that from equity research to the bigger world there, Tom. Like, we'd love to know.
I think the interesting thing about being an equity research analyst is it's a tough job in many ways. Just to try to pick the winners, but you have these forces. You have a management team that everything you write, every sentence you write is scrutinized, right? And it's out there publicly. And one of the challenges I had as director, you're mandated to send your research to all the institutions at once, even if they don't pay you, right? So there's a bunch of challenges with that. You're supposed to widely disseminate all your research, etc. But whether it's a management team or, I won't say Fund X, but I won't name specific funds. But if you downgrade a stock, the management team's obviously probably a little upset. But the funds that might have just put in their portfolio, and I had a couple of cases where a major fund, one of the biggest in Canada or the world, made a $50 million bet, a couple weeks ago on a stock, and then I downgraded. And they're pissed off. You'd think they'd be more like, hey, I want to hear, but they just went to their investment committee and said, hey, we love this stock. It's the best company going. We got to add it. And then, a couple weeks later, I'm saying, I didn't have a sell on it, but I said, hey, there's some challenges. We got to move it to hold, and we don't think they'll keep up with their growth rate and all that stuff. So anyway, there's a lot of force. And then investment banking, thankfully, I had no conflicts. So they said, hey, we're going to cover good stocks. And if you join us as an investment banker, you're going to have to figure it out. But in many cases, investment banking will be like, hey, put us on the stock. The company hates us. We can't do financing anymore. So there's a lot of factors. Like, you're kind of in the middle of the storm. And like I said, the one challenge is every little piece you write gets scrutinized or whatever. So it's a tough job. But the good news is, if you try to fly through that noise and just be authentic and really try to get to the facts, eventually that'll win, right? And even in the case of that fund manager that got upset with me and actually cut us off from trading for 6 months. 6 months later, they called me up and started swearing, and I'm like, oh geez, what's going on? And he said, management lied to me. I said, no, And he said, you were right. But it took him 6 months to say that I was right. And I said, well, management didn't quite lie to you. I just, distilled the facts and
Yeah.
showed clearly why they can't get to that growth rate.
Yeah.
And they were sort of giving a target of the industry growth where they just weren't going to achieve it because their attrition and maintenance was going to be too big and da 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 da. It was just kind of a math exercise. It wasn't a it wasn't being mean to management. It was just like the math's just not going to work. They just won't be able to grow enough license revenue to offset this. And then 6 months later, they finally called me back and said, "Oh, you're right," and whatever. I said, "Well, I just tried to give you the numbers and what have you." So the good news is that you sort of just it's about gaining credibility, and you gain credibility with the management team. So I did have, thankfully, even when I sometimes went to underperform, the management team, if I explained it clearly. They would love it, but
Yep.
they would understand, and they would still
Yep.
they wouldn't shut me off the phone. I'd never been banned from conference calls, that type of thing, even if I had slightly negative view. The good news was I tried to cover enough companies that I was very positive on that there wouldn't be too many of that. Like it just if there's a small company that we didn't like, it just wasn't worth the economics of saying it's a short at 100 million market cap. The 5 people that own it aren't going to sell it probably, and you're just not going to make it. And if it does go to zero and you're right, you're not going to get any economics anyway. So you tried to cover the companies that you felt that were going to be strong, and there was thankfully enough technology companies and as a boutique, I could cover big caps, small caps, everything in between. So I had a really clear choice on covering the best companies, and then you get to meet management teams and board members and such. So you develop a strong network, and that's what ended up carrying me through to venture capital and eventually joining boards like QHR and what have you. Is just that you try to gravitate to the people that you trust, have a strong track record, and just you want to be associated with because they're going to work hard, have strong ethics, and be successful, right? So that the good news is, as an analyst, it's tough to sort of be in the middle of that firestorm at times of competing interests. But if you try to do it well and stay authentic and develop that credibility, it's benefited me now. Such that shareholders trust me to be on the board of directors and make sure that there's good governance and make sure the audit partners are strong and all that good stuff.
And so, what was special to you about QHR at the time? Because QHR is basically a precursor to Well Health Technologies today. Yeah.
Well, it's simple, and this is eventually what became our thesis on is Canadian healthcare is so fragmented, and it's probably, I think I could probably say that maybe real estate at the time was the same, but just so underrepresented in leveraging technology to make it more efficient, right? Many other industries, auto industries, enterprise, Loblaws, all these guys have a great use of technology to make their businesses more efficient, but Canadian healthcare, because it's largely single payer, maybe there wasn't incentives or the will to try to make it more efficient. QHR was one little piece of that. It was electronic medical records, and all of us have had frustration on, can we access our records? Can we get access past records? When we see a specialist, it was faxed over, and was it faxed back? Did the specialist see the fax? It's just all of us have had frustration on. Especially if you've been in technology for a while, like this has got to be easier. How come I can't get a text to notify of my appointment? How come I can't log in and book my appointment and see the 3 or 4 appointments next week that are available? Right? You're trying to call someone that's never going to answer the phone to book an appointment. Why I'm in the waiting room for an hour and a half? Right? There's some simple things that technology could solve. So electronic medical records is part of that. There's obviously a much wider ecosystem, but we like EMR because it's a desktop. Every doctor is looking at that every day. So it's kind of the first window into the system. Obviously, if you have a healthcare issue, you're probably going to your family physician first. So it's kind of the first point of contact and the first bit of records that you're probably going to have. So I feel it's highly strategic. The other thing I liked about it, it has like 0.5% attrition. Like once you're on an EMR system, doctors do not like change, and it's super sticky revenue. And then the thought is, can you add more services around that to make the doctor's life better and increase your price per seat? So anyway, QHR, I was able to join the board. I think it was, geez, I was barely 40 at the time, so a bit young, but we made some really positive changes. Already had a great footprint, great founder, but we had a little bit of U.S. operations that just was a bit of distraction and not helping EBITDA. We were able to sell that and just make it a pure play SaaS EMR company that followed the Rule of 40, and just had a great outcome. I think it went up about 300% after we made a few changes, and thankfully Loblaws came in to talk to us about e-prescribing. We were able to do an e-prescribing platform for hundreds of thousands of dollars, where Canada Health Infoway was trying to outsource it for millions of dollars to get it done. It just tells you the inefficiencies of healthcare. Obviously Loblaws had this idea about trying to get scripts easy to shoppers and make sure there's no errors, and decrease the error rate and all these good things. And when you do e-prescribing, we can kind of check stuff like dosage. Does that make sense? And just kind of flag anything that might, right? Handwritten notes, it's hard to try to look at that and see if it makes sense for the dosage. And obviously pharmacists are trained to kind of look at that, but it just helps the whole system of making sure that you're getting the right prescription. And we can also quickly warn people that, hey, that person has diabetes, maybe this drug's a little better than this drug, or whatever it might be. There might be some bit of conflict. So we can have some decision support, we call it, along the way that helps both the physician, or sorry, the family doctor and the patient. So we thought that was a very strategic asset, and so did Loblaw's. And I believe it was for Loblaw's first major technology purchase of a company. So I was able to lead the special committee to that, which was a great experience for me at that age. And Loblaw's was fantastic to work with. And we got a good outcome for shareholders. But the great news was we knew the employees would be, we felt they were going to continue to make investments in both the employees and the platform, and they continue to grow since. So fast forward, and the CEO that we put forward at QHR, he was very young as well. I think he was 42 at the time. And he was a bit new to capital markets. And of course, that was my history. And I helped him a lot on how to, present and talk to different accounts. But also Hamid Shabazi, who eventually founded Well Health, was at TO Networks at the time. And they were similar market cap, similar revenue. And they would go to a lot of the same trade shows, investor road shows, and got to know each other. So fast forward, and Hamid got to know a little bit more what QHR did. And when it got acquired, and then eventually TO got acquired, Hamid came to me about 3 months later after working at PayPal. He's not a big company guy. He's more of a builder than a big company guy. Loves PayPal, but that's not him. And he was itching to do something new. And he said, "Why don't we do something in healthcare IT? Because I love the moats and what QHR was starting to do." And that became the ground floor of Well Health.
That's really interesting. And I believe it was a reverse takeover of a yoga apparel company. So I guess if Well didn't work out, you could have been selling yoga pants.
Yeah,
competing with
I don't know
Lululemon.
if I'd be a good board member on a yoga apparel company. But I know it was its own consolidation play, and I'll just say thank goodness they pivoted.
That's really interesting. And I remember coming across Well Health Technologies, then knowing about Hamid and his success with TO selling that to PayPal, and I thought, wow, this is a jockey and a horse that I want to bet on. And I remember first investing in Well Health around 20 cents. This is years back.
I think you beat me by 18 cents or 15 cents or something. It was more like 35 maybe. I
haven't sold one share. I've just been accumulating just because I believe so much in the company. But Tom, why have small cap funds then and to this very day? I have found, this is anecdotally, that they've been sleeping on Well Health. What's the reason? There's quite a few funds that haven't accumulated.
It seems, I think this goes back to tech in general. Even when I was, basically even like 2000, I started in 99, but even like 2003, 2004, I think most funds, and this has changed, but most funds back then were very comfortable in resources, financial services, because that's what Canada was really good at. So, if you knew oil and gas, and obviously know the inputs, and you can discern which one might have more leverage to oil price increases or whatever, and not that all look the same, they all look very different, but it's sort of similar. The case in Canada for example, I covered Descartes at I think 40 million market cap, and it's 15 billion now, right? Constellation way back. Descartes was very unique, and you didn't have 10 Descartes in Canada. So the education of the investor, and they want to put that extra time into, spending all that time on Descartes or Constellation or SXC Health that became Catamaran. That was a complicated one because it was mainly U.S. healthcare. Do you want to spend all the resources to cover that, or do you want to spend a bunch of time on Tim Hortons and some other stuff where you could, spend a little bit of time, a whole bunch of these, and get a long way? Yeah. So and Wells probably no exception. So we have some huge, some funds that you would know, and I think some of them have publicly talked about their investment in Well. But we're probably not as broad from a Canadian institutional investor audience as we probably should be. Yeah. And there's a few reasons for that. Just caveat, we're in a quiet period. I won't mention anything recent, but we've had enough press releases that we can certainly talk about. And this strategy goes back to almost 12 months ago, where we said, a lot of investors originally didn't like our owning clinics. They want us to be a pure play technology. We'll get to that, but there's a fix on that. They can now have a pure play on our technology. A decent amount of investors did not understand our U.S. businesses. Not that they didn't want to, it was so much work to understand, why does Circle or Wisp, why are they growing at 30+%? And could their revenue get chopped in half by Amazon or Walmart, or I don't know who they were thinking of, but so, they're always, him and hers is kind of a competitor. So it's what they don't know, and they feel the learning curve, I think, was probably too high. Yep. So I think they, in many cases, sort of, they know CRH is a bit of a separate, but they know it's a cash cow, so I think they got some comfort in that. But something like Wisp or Circle, it's becoming much more material in terms of valuation. They just didn't have the domain expertise, because it's they're all U.S. assets, selling against U.S. competitors. The environment's much different down there. So what's interesting is more and more they became more comfortable with the Canadian assets, and more they're actually starting to love the clinics now that they've seen the results of what we do. And their ROI is off the charts on our clinics. We often get them basically for free, right? Or a very low multiple, and able to slowly transform the EBITDA multiple higher using our technology. So more and more they're becoming comfortable with our Canadian assets, but still aren't sure. So I think it's just that the amount of effort and learning curve to get to understand those assets. I get a front row seat, so it's easy for me to get comfortable, but I get it, right? Because I live this day to day, whereas they're looking at 300 stocks and they want to spend the extra. I do think it's changing. So about a year ago, we just more and more, we talked about the sum of the parts. We felt, if you looked at public comps, that you take out each of our divisions, and we keep adding transparency to our disclosures. We've added every division and their EBITDA and revenue. So you see there's positive EBITDA on every division. You see the growth rates in every division. So we've had that transparency to get people more comfortable. But we took it a step further. And if you looked at public comps and you took out all our divisions, you could get a potential valuation that's much higher. Now, there's always holding company discounts. There's all those good reasons why that would be discounted. But we felt the gap was quite wide, and I think we were trading, $4.50 at the time. And they said, hey, look, if our investors are telling us they're having trouble understanding, or they think there's too much risk in some of these assets, hey, we're going to get good value on these assets. So let's think about selling the assets that are up fivefold in revenue and have attractive potential acquisition targets. And if you want a pure play technology company, which a lot of them do, we can look to spin out or create a separate vehicle for Wellstar and put our technology focused companies in that, and you can buy that specific vehicle if that's more what you want to play. So, meanwhile, the Well Health as a whole is unlocking value as well. So we're giving people more of a choice, and I don't know if we're simplifying it a bit at the same time, but certainly making it easier if it's more Canadian centric. At least the assets that may be harder to understand, we'll see, but we at least talked about exploring sales of the two assets of the U.S. companies. So obviously CRH will will maintain, but the other two. And I think and that's probably why the stocks perform better.
Mhm.
Obviously, the quarters, we continue to hit the quarters, and at some point too is you can't count on this forever, but if you see all of our divisions growing and having positive EBITDA, at some point you still get a little more comfort even if you don't understand all the dynamics of each
Yep.
division. So anyway, so we think that's been helpful. We're all about as much transparency and what we can to the street to help them understand the story. And we're the good news about Hamid as I think he's one of the best capital allocators going, and you know people like Constellation and Mark Leonard and Steve Sadler at Encho's have been mentors, and he learned a lot from Tio. He will explain to you. He said, I made so many mistakes at Tio. We didn't do our initial acquisitions right. Like, he's a very humble and just constantly learning and seeing where he can improve. And he was very young when he started Tio, and now he's still quite young. But he's learned those lessons, and we've done what? A lot of acquisitions to date,
Yes.
and we've never had a write down. And that tells you something, that we have a strong capital allocation program. And the flip side is, hey, if we want to flip it out and that creates more value for the whole, fine. Like, we're not married. We got to $1 billion of revenue. You think you'd almost want to stay there and continue. If we sell something and come back down a little bit temporarily and redeploy it into
Hmm.
assets, that's what a lot of our investors do want. Is if you can sell one or two of your U.S. assets and redeploy it into clinics and technology in
Yep.
Canada and have more synergies, and then that's fine. We don't mind making that move.
Well, health is an incredible Canadian success story, and I just feel the story has so many more years. I was just driving through my neighborhood. I'm on the board of Mississauga and Oakville, and I saw the Well Health banner on one of the recently acquired, I think, clinics in the area. Take us back 8 years ago when it was those very early meetings, Tom, between you and Ahmed. What was the vision for Well Health in those early
So
days?
it, I'll be honest about that. When he first we sat down for lunch, and I've known Hamid for 20 years. I never did actually cover TO. It was a bit small, and then I forget it. But I always, every time he came in, he was just always transparent. And if they had a not so good quarter, he'd be like, "Here's what went wrong, and here's what we're gonna do about it." It wasn't like, "Oh, it's just it was just a couple sales slips." Like most CEOs will maybe not lie, but kind of exaggerate why they missed a quarter, right? He would just tell you exactly, like, here's what happened, here's what we're gonna do about it, and then he would fix it, right?
Yeah.
And he was just always ultra transparent. So always had a lot of time for Hamid.
Hmm.
And I did own Tio for a while, although I didn't cover it. But we sat down not long after, maybe it was 3 to 6 months after he sold to PayPal. And he said, I'm thinking about kind of healthcare IT roll up. Like, there's just so many opportunities. And I was on QHR. It was a unique committee. We called it Corporate Development Committee
Hmm.
because we had definitely some internal M&A capabilities at QHR. But because I worked on Bay Street for so long and saw all these acquisitions, we wouldn't get in the weeds with the company, but we'd help, kind of framework what we wanted to do. And we had, goals to continue to expand QHR. And then we got this offer that we accepted. But so I get to see a lot of the other companies in the Canadian landscape. And at the time, Hamid said, we should buy the Oscar assets. And Oscar is an open source platform, and there's a bunch of providers that implement this open source platform and provide services, much like Linux or whatever other analogy you want to use. And I said, at QHR, we were used to saying we're much better than Oscar because we were premium priced and, whatever. I'm like, no, Oscar, no. And, you were a little worried about cybersecurity because it was open
Hmm.
source. But I'm like, wait, if we buy them all, we can make sure that the code's tight and solve any potential. There wasn't any to date, but you just always worry about cybersecurity issues. And Hamid said, well, we can buy these more at 2.5, 3 times revenue instead of 6 or 8. And there was a couple new EMR companies
Yep.
that wanted 9 times revenue on a handful of million of revenue, a million revenue. And the challenge is, as I just sort of alluded to, even though your software might be a fair bit better, doctors don't
Hmm.
want to change.
No.
So it's a slow the organic side of it can be pretty slow. But here, Oscar had, I think, roughly 15% market share plus in Canada. So, a few years later, we end up buying them all. And what was kind of interesting, which we bought clinics, some clinics at the same time. We bought mostly they're mainly Vancouver based at the time, the early ones, and they were the most innovative clinics. So two things: we wanted to learn the ecosystem and what else had made an efficient clinic, right? Obviously, EMR is the desktop, the lifeblood of it, but what else did they do to make that super easy for patients to book meetings, to reminders, to all that good stuff? And the good thing about clinics too is we bought some ones that were reasonably profitable. No clinic is hugely profitable, but reasonably profitable, and it created a little bit of cash flow that we could use as well for acquisition. So there's a kind of a double reason for that. So we were never a pure play tech, but at the same time, people had comfort that we had great revenue, good cash flows overall, and even the EMR, Oscar was cash flow positive from the get go when we bought these companies. So the good news is early we were buying businesses that were already flowing cash, and that certainly helped us in our initial stages. But from that beginning, we were able to buy things like many years later, Ocean, which is the referral network, and you started to piece together stuff where, hey, if we can consolidate this information and give the patients much better access, make the physicians' lives better. Yep. For example, we have a product called AI Scribe that I think, a couple studies have said it's 15 to 20% more efficient for the physician in terms of seeing patients, because instead of writing down notes and at the end of the day consolidating those notes and then putting them in, it records a conversation with the patient and it knows which pieces to put into which field. It uses AI to trigger that, and you might have to do a few light edits at the end, but it basically auto populates all that data, which is a huge savings for the physician, and then it allows them to see more patients in a day. And we have a doctor shortage in Canada, so how's one small way to solve it is if you can see 15-20% more patients today of the existing networks using this technology, that alleviates a fair bit of it. Obviously, we still need more doctors, but there's a bunch of ways that we can make the physician's job easier and just focus on what they want to do, is seeing patients and helping patients rather than taking notes and transcribing notes and doing all these admin type stuff. We want to use technology to make their lives way more efficient in a day so they can see more patients and focus on patients and outcomes.
There was a major vote of confidence in WELL Health Technologies fairly early on when Ka-Shing, the Hong Kong billionaire, his investment arm took a stake, I believe, invested in WELL Health Technologies. How did that come about? How does someone like him in Hong Kong come to know about a little small cap?
It's the long story, and I'll forget part of it, but it was, I think it was Mark Benioff at Salesforce had I'm making this up a little bit, but C100, summit and whatever, and Hamid ended up getting to know Benioff and Ka-Shing and getting an introduction. And slowly but surely, when he was explaining the vision of Canadian healthcare and what we were doing, and thankfully we had a bit of success already by then, Ka-Shing saw some similarities of early businesses that he grew. I think he had a pharmacy or drugstore chain and some other things that he grew in different parts of the world. And Hamid, again, he's authentic, and by that time he's proven himself a couple times. He'd proven himself at TO, and then we had some early success at WELL, and it was quite early on that he made that bet, and it was certainly a sign of confidence that you have this amazing entrepreneur. I think he's top 100 richest people in the world. Bet on this tiny company, right? And it's partly track record, but it's a lot of management and the vision that he had. So that certainly helped when we're as a calling card. It's interesting because you have one of the richest people in the world investing in us, but it's hard sometimes to get small cap managers to see that.
Make sense.
Now that's changed a lot, but it was a great endorsement, and his relationships are phenomenal. So that's we have some investors, Singapore, Hong Kong, all over the world because of it. They follow his advice and track record from himself. So it's been a huge early endorser for us, of course.
Yeah, I believe the investment arm has taken the investment up to, I think, 14.5 or 15%.
Yes.
In the company. Yeah.
Yeah. No, it's great, and then it's been stable, and almost all the fundings they'd always participated in, usually roughly their pro rata ongoing. Yep. So it's just great to have that stability and a shareholder base, and management owns a lot. One of the things Hamid said at TO, you're always going to get diluted over time a little bit as a CEO, but he's trying to maintain a healthy stake, and the board members, we, besides a little bit for charity, I've never sold a share. And most of our board members have been buying in each round as well. So it's well held by the people that know us best, which is probably hopefully a good sign for folks out there.
Yeah, what was the most transformative acquisition that Well Health made, Tom, in your opinion?
Oh, wow, that's a great question because we've done a
Yeah,
whole
a whole
bunch.
lot.
Yeah, I mean, kind of maybe two for very different reasons.
Hmm.
It wasn't, and I get it, wasn't as well received at first as
Hmm.
CRH Medical, the
Yeah.
US. And partly because it was a public company, and I think 2 years before they went through, maybe it was 18 months, whatever it was, a restatement, which is obviously never a good sign. And then CEO transition, a bunch of things like that. And meanwhile, they were slowly regaining confidence. Their numbers got better.
Hmm.
They made the changes that they had to make. And then COVID hit,
Hmm.
and they physically, the anesthesiologist had to physically see people, so obviously that took life out of them. So they just were sort of, as they got some credibility back, they took a revenue hit. But you couldn't predict COVID exactly. But by the time we looked at it, it was starting to come back a little bit, and people were making adjustments and what have you. So meanwhile, it was a low valuation. It produced a lot of cash,
Hmm.
and we knew at some point, and we even talked about this in our conference calls, like, hey, we love being a virtual care company. We love that part of it, but at some point COVID will die down, and virtual care will always continue to grow, but the
Hmm.
little initial spike and the hype around it will die down a little bit. Meanwhile, we're a super well diversified company. Our EMR business is going to be steady no matter what. So we knew at some point the valuations would turn a little bit at least. And we loved having this great asset, undervalued. It was kind of a Mark Leonard type move, right? Where it just underappreciated,
Yeah.
flowing cash, and you knew it was going to be steady grower at great margins. And we knew that would help fund, allow us to do a bunch of other things.
Hmm.
So we wouldn't have to issue as much equity, right? If you can fund acquisitions through cash flow, that's a much
Hmm.
better thing. We've always done a combination of all the above. We have earnouts, we have some stock that we often do when we buy companies and what have you. But to have a business that's flowing a large, good cash flow is fantastic. So in some ways, when the valuations change, and I mean people like Teladoc, which we're not really a comp. People sort of comped us because it's convenient, I guess. Maybe it helped a bit on the way out, but it certainly hurt on the way down. And we tried to distance a little bit because we were much more diversified company
Hmm.
than something like Teladoc. But when that happened, we knew we'd had cash flows. And what was interesting, we were able to buy smaller assets of companies that were EBITDA negative and needed to divest, because we had good cash flows and we were relying on stock price to buy it. There was a time where the valuations were so high, everybody was just trying to go public, and we had a bunch of copycats,
Hmm.
and they were just trying to throw stock at these companies to acquire them at premium prices. And we were a little bit disciplined and waited for that to clear. We had cash flow, and we were able to buy them at much lower prices. So in some ways, it was transformative. That it was. You want to be this pure play in many cases, but we knew we could transform and digitize that asset as well and create even better economics from it. So we were trying to find a number of different assets where we can use technology to increase margins, but also increase customer service as well. So the second one, I think Ocean. There's a bunch, but Ocean was interesting because it basically owns e-referral networks in Canada. Like, right, where there's many provinces to go, but my mind, we're just so far ahead of any competition, and just a natural for provinces to accept. So they had a number of fairly big wins not long
Hmm.
after we acquired them, and I just love that asset because it's just so helpful for patients and physicians, but it also is a great moat, right? And it integrates well with all of our other technologies, right? And between us and Healwell, we're a very data driven company, and the more data we can give our patients, and the more data we can give our doctors, and the more AI tools we can do to wrap around that to help promote better outcomes. It's the same thing as I meant with AI Scribe. Like, if we can improve outcomes or improve the amount of people we see by 20%, but we could also improve outcomes, which in many cases some of the Hillwell technologies do, the more data we have integrated around that patient, the better outcome and better data, better decisions your physician is going to help you make.
Absolutely.
So that's the overarching goal of everything we do is we want better outcomes for Canadian patients. And Ocean was a part of this. Instead of sending faxes back and forth and getting lost and missing appointments and all this other, the data not coming back to the doctor properly, we just have a much better experience for all participants and stakeholders in it. So I just thought that was interesting because it's just such a dominant piece. But there's so many great acquisitions that we've done, thankfully, and just great founders. One of the things was I don't know if it's not a secret, but what some of the owners of these businesses and Constellation, I think Jason Donville might have talked about. He did talk about this with one of the acquisitions that he met when he was at a lacrosse tournament or something.
Mm-hmm.
When we bring on a CEO, we want him to be part of the journey. We don't want to just say, hey, you cash out and here's a big multiple and go retire. And a lot of times the CEOs want to be part of that journey, but they don't want to raise money. Raising money takes way too much time. The greatest thing about Hamid, he's really good at raising capital. And we can be smart capital allocators at the same time. You don't want to deal with some of the HR. You don't want to you don't know how to scale R&D. You don't want to do back office stuff. You want to be you became a CEO to be visionary and to run the business. Mm-hmm. And you quickly learn you have to do all this other stuff that you don't want to do, right? So we want to take that. We want to take the hard part away. We want to take the back office part away. We want to take the capital raising part away. We want to take the budgeting, forecasting, and help you with that, and and allow you to continue. So we often have shares that the CEO will obviously the CEO founder of a company probably has a fair bit of ownership in his company, so he's going to receive a fair bit of those shares. We have earnouts. So, and we have obviously bonuses and everything else. So we're trying to completely align that CEO, take all his distractions away, and let him or her run the business the way they wanted to, with full-time effort and full-time focus. And that's served us really well because in some cases we don't know that domain as well. Like Ocean, the e-referral piece, we could learn it, but Jeffrey was the expert, and he founded that company. We want him. We want his intellect and domain and expertise and everything else to come along with us. And the great news is we've got such a great team, and we're sort of all cheering for each other. And they meet multiple times a year, and they give each other great advice. Hey, this is what I did, and I can introduce you to this province or whatever it is. So there's great synergies and having all those brilliant founders continue to be part of the team. So that's been a really important part of our success is to have, Hamid's not going to run all these divisions. We need those founders that there's a reason why they became successful. We just try to accelerate their success by, using our network and taking off the pieces that is difficult for them to deal with.
It's a decentralized model, but then you help fuel and scale these companies. The recent acquisition of, I believe, Jack Nathan Health put Well Health into Walmarts across the country. In that pursuit, Tom, you and Hamid, is there a market share number in mind as you want to become Canada's clinic, basically?
Yeah, it's I'm pretty sure our number, and this is all Hamid's data and expertise, but I think we're barely over 1%, right?
Wow,
and we're the biggest, so it tells you something.
Yep.
And most physicians will tell you the clinic model is tough because you're barely getting enough, and most of them are. If your audience doesn't know, basically most clinics run at EBITDA neutral, right? Like you might have 2% positive. A lot of cases you'll have negative 4%, and it's not. Many cases physicians just don't have the time to really negotiate leases, to manage those upfront technology deployments where. Like I said before, a customer can pre-book they get a text. They can within 5 minutes. We know when that customer is going to be seen by a doctor, right? You don't have to wait in the waiting room for an hour, right? We will text you in 5 minutes. Your doctor is about to see you in room B, right? And by that time they have your healthcare number and they have some of your symptoms already, so they can see you right away. Then they use AI Scribe so they can shorten the meeting. They don't have to worry about taking notes. They can just really get to your problem, focus on your problem. And quickly try to resolve it. So Yeah. So anyway, we've done a great job of rolling out those clinics, and there's a lot more to do. The good news is, I mean, not good news per se, but physicians are sort of handing the keys over
Mm.
to us now, and partly, yeah, they didn't grow up as a physician. They want to help patients. They didn't grow up like, I want to manage payroll, right? I want to manage HR. That's not really part of what got them excited about the profession. And more, we're getting word of mouth that we're helping them do their jobs a
Mm.
lot better, and they don't have to focus on the stuff, and they get to see more
Mm-hmm.
patients today, which is what they really want to do. So whether they're making 2% or negative 2%, and then we go in and we're obviously doing tons of due diligence on this, and we have a great head of this division that just knows how to make these clinics hum.
Mm-hmm.
And I said we're the only ones dumb enough to do this. It's hard work, right? Jeremy, our leader, is just fantastic at this. But now we've got the tools, so more and more, it's a bit of a playbook, and over 6 months we'll increase margins by 3 or 4%. Over 12 months it'll be 8 to 10, and then we'll sort of get it into 12, 15, and we'll see where we go from there. But as they mature, but it takes a while to do this. But in the day, we also give a better patient experience, and we're pretty passionate about that, and the physicians are happier too. So when you can do all three, make a little money, have happier patients, see more patients,
Yep.
doctors, it becomes attractive model. And that's why now we're more across Canada now, and we got a good word of mouth that if you don't want to have to manage all the stuff, which most of them don't
Mm-hmm.
want to, we'll take it over or pay a small fee. We'll deal with leases and do all that stuff, that hard work to get it profitable. More importantly, alleviate you from all the burdens of running a clinic, and just seeing more patients, which is, again, what they grew up wanting to do.
That's interesting. So doctors are increasingly knocking on your door, because they're seeing you, they're hearing about you from their colleagues. You touched on it, Tom, but can you tell us more about the strategy behind Heal Well AI?
Sure, and I'm a little bit distanced from HOL. It's
Yep.
obviously a separate company and separate board, although we own a significant portion of HOL.
Mm-hmm.
We originally inherited, I guess, the ticker. We bought a number of clinics, and separate from that, this company had a bunch of technology assets, and
Mm-hmm.
including some really cool AI tools. And generally speaking, we didn't want to run R&D shops and losses within well. Clinics are easy. We know how to do it. We know how to
Mm-hmm.
manage cash flow. But these kind of earlier stage, and at the time, obviously AI became topic of the day in capital markets. And they had some fantastic AI tools, and we thought that could be a perfect vehicle on its own and a pure play
Mm-hmm.
to acquire other AI. And we had some of our own technology that we spun IntraHealth and into the HealWell. So much like we were talking before, where we get it. Some investors might like mainly the clinics. Some investors might want Wellstar more the technology assets, and certainly there was a big appetite for an AI play in healthcare. I think I can't think of another industry that would benefit more from AI than healthcare.
Yeah.
There's so much data, and it's all over the place,
Mm-hmm.
and physicians are tired and whatever else, and they don't have
Yep.
access to some of this data. If we can provide more, it's gonna create better outcomes, right? Early detection of cancer, which
Mm-hmm.
Healwell has some great tools on a specific form that can really help. All right, the physicians detect this earlier and treat it early, and of course, earlier you treat it, you have a much better chance of improving outcomes. So that made sense to have its own vehicle, and obviously. That was much like the run with Healwell. Now, the good news is our early well investors, institutions, quickly realized that, hey, this was a platform that would make sense as well. So we got some fantastic early support for that. And I mean, the number of acquisitions and fund raised, I think, maybe slightly surprised even the most optimistic of us. But it's been really well received, of course. And again, we just acquired Orion, which
Mm-hmm.
has huge data, and that's going to help. The AI tools are there. It's just a matter of getting the data and getting it in a good form that they can make just great decisions based on that. So Orion, I guess it hasn't quite closed, but it's I think we got approval from New Zealand from the competitive side of things. So it shouldn't be too long, I believe. But just a fantastic vehicle to again, and then there's some synergies between the two companies as well.
Yep.
which is great. Government of Canada saw that and realized that, again, we need more doctors, no question. But there's lots of things you can do in the interim to improve outcomes and see more patients. So we can help move the needle a fair bit in the interim as we continue to recruit more doctors.
Yeah. And then in Wellstar, which was recently announced, is there a future spinoff that will happen in 2025, 2026? Can you tell us
Yeah,
a
so
little bit more?
it's step one of a
Yeah.
spinoff. Like it is essentially its own vehicle now. Now it's inside of Well 100%, and there was a private money raised, and there was three. It was in the press release, three significant funds that came in,
Mm-hmm.
and again, some people want more of that QHR or pure play
Mm-hmm.
or Vital Hub type of model where it's a pure play. And I think we gave the pro formas, but the valuation is somewhere around kind of 4 times revenue plus or minus.
Mm-hmm.
And that allows us to do acquisitions because our overall blended multiple is much lower because we have clinics and maybe slower growth pieces as well. High cash flow, but slower growth. So, a SaaS company will enjoy richer multiples usually for a bunch of reasons.
Mm-hmm.
And so it made sense again to unlock value in these assets, and it's approaching. I just want to make sure what we said exactly, but it won't be long before it sort of gets to that 100 million revenue mark, which is a sizable number, right? We're a little short of that now, but that has its own vehicle that can use cash and currency to buy companies at slightly higher multiples than our overall value.
Mm-hmm.
What makes sense is a pure play, and the investors want that pure play. So, there's more companies to acquire. So stay tuned. We'll see. We talked about being in negotiations with the number, but it's another value enhancing thing for all of Well shareholders, and it makes sense because it's at a size now where it can have its own management team and what have you. Like before, it was a bit small, but now that we've made a number of acquisitions and sizable, growing, recurring, all the good SaaS metrics that you'd want. And again, so the attrition's so low, right? Because people in this industry, people don't like change. So it's a great model.
So what caught your interest, if we move off Well Health, in Tantalus Systems, Tom?
Yeah, so obviously I want to just get involved with great companies with great moats and what have you. But when you think about the future, you think about healthcare, and you can see dramatic improvements in what technology can do for the healthcare industry. I think that again doesn't solve all our problems in Canada, but you can do a lot of you create a lot of amazing advancements and better outcomes because of it. But power is a big issue, and in the U.S. where Tantalus largely plays, they have customers in Canada as well. But the grid, as you saw, maybe Texas, what was it, almost 2 years ago now, whatever it was, it's kind of duct taped together. Like there's not a lot of reinvestment made, and Tantalus is basically does a number of things, but it's basically the data source, much like Well, where you get the data from all these houses and what's going on, and you can better load management and do all these wonderful things. And the best new application of that, so we sit behind the meter and we read the data, and not only just usage, but more and more we understand what's going inside the house. So if you want to put in a GE water heater that's super efficient, we can help manage that so it heats up in low priced environments or low, right? So we try to, everybody uses power between 6 and 9 p.m. in the household, right? How do you deal with that? Now, not most houses, a lot more houses have batteries. A lot of folks have EVs.
Yep.
The Ford on 150 Lightning can actually go two-way. Now, the challenge is if someone in the same block in a certain U.S. neighborhood buys some Teslas and a couple buy some Ford 150 Lightnings and they all plug in at the same time, there's a decent chance that transformer is going to blow, right? It just can't handle the load. And what used to be, I think, a $30,000 fix for a transformer is now like a $100,000 fix with inflation, right? When you get a truck out there, So all these things are just, long story short, the grid is taxed and there's more inputs for whether it's wind, solar, or EV batteries or batteries in your house. There's so many more sources of energy, and there's so much more different kinds of consumption of energy, of which some which wasn't forecasted, right? Mainly because of EVs, but other items as well. So how do we get the utility to understand what's going on within these households, and then whether it's up to them offer rebates or different pricing? How do they manage pricing so they can load balance this network that's taxed, right? It's not quite duct taped together, but it's there's some challenges. It's antiquated technology in some cases. So especially with the with the growth in EVs, like these utilities are kind of panicked
Mm-hmm.
on trying to manage these loads. So we help understand where there might be problems, which where transformers need to be replaced proactively instead of when they fail. How to load balance, how to create incentives. Maybe you say, hey, you can charge your EV from 2 a.m. to 5 a.m. because it doesn't matter, it's
Mm-hmm.
just on an app. But can you if they do have an emergency, can we take energy back from your EV back into the grid, and we pay you for that or whatever it might be. So it's basically just creating intelligence for the utilities
Mm-hmm.
on what's going on their grid. And they've always had some reasonable intelligence, but now it's getting much more complex because of all the energy sources and all the energy
Yeah.
uses are much more complex. So I love that you can try to keep as much of the aging infrastructure as you can and just trying to manage it. Obviously, you're going to need to upgrade as you go, but energy is a big part of you need housing, you need
Mm-hmm.
you need food, you need healthcare, and you need energy. So those are obviously some themes that are going to last, and then they have a very good moat with their customers. They've had customers that repeat buy every year for 15, 20 years. So it's once you're embedded, and there's an ability for us to sell more stuff because we provide the utilities more and more value as these new sources of energy and new sources of consumption come online. So that's been a good one. That was actually an RTO, and it was one of the bigger
Mm-hmm.
RTOs that Canada did in tech. And we had a team, including Hamid, was on our board, and we called it Rise Tech, and we were looking for more mature companies that wanted to vent in and have a set group of great investors and potential advisors. Whether we were on the board, I stayed on the board, but whether they're on the board or not, we just have a great network of CEOs that had raised a lot of capital in public markets. We had one of the best tech lawyers in Canada on our board, and just to have that network of advice, because some folks were going to RTOs and maybe didn't have the best sponsorship group. Maybe they were an RTO that was more specialized in mining, and all of a sudden did a tech RTO. And we just felt that it'd be good to have a good network. But we also did the RTO transaction where Copperleaf and all these were going at good
Mm-hmm.
valuations, and then the market fell out of small cap tech fairly rapidly not long after. But the good news is we persisted, and the stock's been doing really well lately, and the market sees a big future. And I think we have 5 or 6 analysts now covering us, which is fantastic for the market cap we're at.
Interesting. Does it operate exclusively in the U.S.? Will it be operating in Canada?
We do have some clients. I'm pretty sure Hydro, BC for sure, and
Okay.
there's a couple other tenders that we have out in Canada. We're mainly we do some work with the investor-owned utilities (IOU),
Mm-hmm.
but we're mainly the co-ops and municipal utilities. So it's a segment of the market that we serve a little better. The giant IOUs tend to be a different vendor, but the market's so massive, and we do have a play where we can still access even using the incumbent's meter to get some of that data layer in there. So there's still a play with the IOUs and some others.
Mm-hmm.
So the market's very big, and it's definitely and it's consistent. Like I said, the customers stay with us for a long time.
Tom, can you tell us about some of the other investments that you've made through your family office, Water Street Capital?
Well, most of it's like long-standing, and what's interesting is we could. So when I became director of research, the compliance regime, which is good, but
Yeah.
it became challenging to own your own stocks, right? Because
Mm-hmm.
and we would say, what if I owned like SXC Health, which went from 40 million to 16 billion market cap? At some
Mm-hmm.
point, from a portfolio diversification, like you let them run, but you got to trim some, and you still have a buy because you still think it's going up. But if you're a portfolio manager, you naturally trim some at some point, right?
Yep.
Hopefully, you let it ride for a while. So there were some complications, like you couldn't sell against your recommendation, right? And you might have buys in the stock and it continues to go up, and you sort of don't get rewarded for anyway. So we had some challenges buying and selling our own company. So
Yep.
but then after I went to venture capital, I started buying the Descartes and Constellations of the world. So I mainly buy the names that I used to cover that. I just had so much trust in management. I've also diversified, if you will. I bought a rental building slash, retail thing in my home province of New Brunswick. I invested in a brewery in New Brunswick. I still have some great roots in New Brunswick. So I do a couple other things besides tech. But tech is always, I still come back to public tech stocks for the most part. Still own a little bit of Amazon and
Yep.
Microsoft. Sadly did not buy enough Nvidia and sold too soon. But I got to learn. I'm not a good trader. I'm pretty good buying and just holding. I somehow thought I was going to be a good trader, and that didn't work out so well. So
So if we go back to New Brunswick, where you're born and raised, you're a basketball fan. You're a certified coach, I believe, as well. Tell us about basketball and what that means for you.
yeah, when I grew up in New Brunswick, I was a bit of a shy kid in sort of grade 7, 8, and made the basketball team in grade 8, and we had this phenomenal team. It was just a real tight team, but we were also one of the best teams in little old New Brunswick. But we
Hmm.
were the best teams in the province, and so basketball kind of became an important part of my confidence growing up and all
Hmm.
those good things. And it taught me so many things. I mean, to be on any sports team, it just I think it's
Yep.
so valuable for every. I hope every young person's on a couple sports teams in their lives and learn how to deal with going through adversity and
Yep.
working harder to try to get out of that and having some failures. Like some of our parents tell me after every year, it's like our kid doesn't go through much adversity at school. If they fail a test, they get to rewrite it. If they, and not to pine on what's the right solution for schools, but if they need 2 hours instead of 1 hour, you do it. If you don't pass your assignment in on time, they just said, okay, we'll pass it in next. Like there's not a lot of consequences as much as there probably should be. Again, not to pine on what's happening in the school system, but they need failure, right? And they need to know how to get up. And
Hmm.
sometimes it's okay to cry, and then next game you win, and right, you go through all those emotions. So, I sort of realized how, and I think there's a stat. I have two girls. I think there's a stat on women CEOs. 88% of them played competitive sport. Like there's some
Hmm.
high number
Hmm.
of female CEOs that achieved that. So I was pretty dedicated to make sure my two teenagers now got that environment, got to live that environment and
Hmm.
all the good things that it comes out of playing it. So basketball has always been a passion. I've been a Raptors fan since day one, and season ticket holder for a number of years. I had to drop it when I had two kids because you can't get to games anymore. But it came up that in New Brunswick, they knew there was this historic court, but they didn't know exactly what it was. It was an old YMCA, and it became a thrift shop. It was a bunch of things over the years. It
Oh
was a
my
dance hall,
goodness.
it was a doctor's
Yeah.
office, it was a pharmacy, it was all these different things. And I guess about 8 years back now, maybe a little longer, there was a fire. People would take their used clothes and put it in front of the thrift shop because if it was closed, they just put
Oh.
their donation by the door. And someone either flicked a cigarette or had a little prank and lit it on fire and went up through the front of the building. And thankfully, they put it out pretty quickly. But at that point, the sprinklers went off in the top floor, and the top floor was just storage
Yep.
and a carpet, a drop ceiling, whatever. And when they were trying to clean up the mess and clean up this wet carpet and everything, they're like, this floor looks a little different, this hardwood. And a couple of people in town's like, wait a minute, that was a YMCA. I think Canada's first game or something was played there. And we got to save this thing. Like if there's another fire, like we got to figure out this. I think this is an important
Yeah.
building. So they spent 2 years. And the good news about late 19th century, early 20th century, the local paper documented everything.
Hmm.
Someone was walking backwards down the street. They talk about whatever. They talk about everything. So there was great documentation in the microfiche of like when the first game was played, when Lyman Archibald came to St. Stephen, and Lyman Archibald. If you look him up, if you look at the first basketball team ever was Naismith, Dr. Naismith, who invented the
Yep.
game. It was his students, right? Because obviously he was inventing the game with his students. And they became the first basketball team. And Lyman Archibald sitting there at the front row, and he says from Truro, Nova Scotia, and he became the general secretary of the YMCA in St. Stephen. And all of his 12 plus students took the game all over the world, including Paris, France, and Toronto, and Kansas, and St. Stephen, New Brunswick. And of all those original basketball courts, there's only two remain. The rest were burned down, including the first one in Springfield. The first one would have been Springfield College, of course, where he invented the game. That's been a parking lot for 100 years and now has McDonald's on it, right?
Oh my God.
So unfortunately, all these historic basketball courts have burned down or been transformed, and Paris, France still persists, and we found out we were predated Paris, France by, I think it was 6 to 8 weeks or whatever it was. So,
Nice. Yeah.
so we claim we're the world's, which is true. We claim we're the world's oldest court, and it's all been documented. And now we're in the process of raising $18 million, and I somehow became chair of fundraising for this project. But I honestly
Good
love
on
it.
you. That's amazing.
I,
And how long will
I
that
do.
take then? And you're planning to transform this into a museum, right? Where people can come and see and learn
Yeah,
more.
so we call it the National Basketball Experience Center. So
Yep.
two things: it's going to house the world's oldest court, and that's going to be the crown jewel, if you will. But
Hmm.
we have a memorandum of understanding, and we have a really good relationship with Canada Basketball. We'll be a node of Canada Basketball Hall of Fame. So Canada Basketball does not have a
Wow.
physical Hall of Fame currently. It
Yep.
inducts people, right? As you go to a restaurant, they induct people, have a ceremony, but you can't go see their picture on the wall and read their history or see some video, right? That doesn't exist now.
Yep.
So their concept is to have a node in around Toronto and maybe have a performance center attached to it for the Canada Basketball national teams.
Yep.
Have a node in Vancouver and have a node in the East Coast, which because of our
Yep.
landmark will be in St. Stephen, New Brunswick. So we think we'll be the first of that. First node of that Hall of Fame wing, and we have the designs that include the Hall of Fame and everything in it. So the basketball court's on the second floor, but we've have a third building that we took down and can create elevators and more space to create this node of
That's
a
great.
Canada Hall of Fame. So, and we're also only 6 hours from Boston by car. So the Naismith Hall of Fame, which is maybe a little farther, which who we visited, we actually hired the same design architects that renovated the Naismith Hall of Fame, the World Hall of Fame in Springfield.
Yep.
They're in Cambridge, Massachusetts, so they're not too far from us. And there's this wonderful connection between the two, and they're like the world's leading sports type museum design experts. They've developed this gorgeous concept, and that's helped us being able to raise a bunch of money. We were already at 2.3 million of six of our campaign from private and corporate donors, and the Brunswick government and federal will be in for the rest of it. And we think it's going to be a huge economic boost, but it's also preserving this Canadiana. We
Yep.
talk about kind of bringing the game back to, we have a Canadian that founded the game and invented the game. And we tell, what's interesting is no one's really told the journey much from Naismith when he found the game until the NBA in 1943 or whatever it was. Like, there's some people that tell that history. We get to show that exact journey of how it grew. It grew rapidly, right? That's sort of missing from certainly our culture. So it's a super exciting project, and from coast to coast. I wasn't sure because I come from New Brunswick, and this little town of New Brunswick, would people care? And we've been able to get Jack Armstrong and Paul Jones and Lisa Tomitis and Miranda, all these wonderful people to come to New Brunswick from all over North America. Actually, Jaren Jackson Sr. came from Texas, who's won an NBA title. To help support us, and it's been just really warming and encouraging on all the support we receive. So it's been taking a lot of my time, but I love every minute of it because it's just such a
Well, thanks for
great,
taking the lead on it,
great
right? It's
asset
so
for the
important to preserve that history, and for the American viewers, of which I think there's about 30% of my YouTube channel, they might be surprised to learn that the first game happened here on Canadian soil.
We've had people, New York, Boston, reach out. Can we come visit? And sure, we'll take. It's basically kind of just a floor. It's not. It's historic. People like. We've had a bunch of the Raptors announcers and ex former NBA players say, like, I got chills walking on the floor, and I wasn't sure that, like I did, because I'm kind of from New Brunswick and I had that maybe pride. But it's so great to see people from outside come in and just like, wow, they can feel the history, and it's been like I said, it's been just so heartwarming, all the support we've gotten. So we're very eager, and we're well on our way to making this super special. And like I said, we're not too far from Boston or New York,
Nope.
so people can make the drive, and
It's an easy road trip, exactly.
easy road trip. You can do both. You can do both. You can almost do both Hall of Fames in a day. Not
Yeah.
quite. You could probably pull it off, right? But anyway, all good.
What's your take, Tom, on starting, I think it was late 2023, and it continues now, of all these U.S. private equity companies taking over our small caps in Canada? Not all, but a lot.
It absolutely kills me. I went through a wave as an analyst too, where companies would go public, and maybe they were at call it 250 market cap, and they sort of get to 600, and then they just sell, right? And it just so I get it. Like in some cases, the board, it's true, the board has to make the decision, right? And if you've been trading at what was Converge trading at until a couple days ago? Like trading at 354. I don't know exactly what it was, but a lot of these companies go through the same math. Trading at 5 times EV to EBITDA or whatever. It's like I've been trading. No, the market's not giving us a reward. So like we got to take this bid. And I just the short answer. And I was quoted in one of the Globe articles a few months ago. And I don't have many magic ways to fix this, but and now it's actually kind of happening where Tantalus and Well are starting to get bid up because it's like oh wait, these stocks are undervalued. But you had to be hitting the head with like 10 takeovers to realize that these are fundamentally undervalued. And it's a problem because if we're fundamentally always undervalued and you want to even use a bit of currency to acquire, it's hard to do, right? So there's got to be we got to get a collective effort, and thankfully to people like you're highlighting these names so they can be better. I get why the institutions, some of them can't come down market cap that much, but we got to find ways to get better support for these public companies because. What you want is a Shopify, and Shopify was unique because it went out as a great valuation. But Descartes, I covered it at 40 million market cap. It's 15 billion. We need more of those. SXC Health, I covered at 56 million market cap. It got taken out for 15.8 billion by United Health. But it had at least a long runway of constantly growing and investors getting good returns from this whole way. Obviously, it went from 40 or 56 billion to or 56 million to 16 billion. It cycles through a lot of investors. A lot of investors had above average returns because they were able to buy Descartes and SXC and Constellation, right? Yeah. And thankfully, Constellation hopefully won't be ever taken out by private equity. Too big now, probably. But we need those names to continue to skate, and we need to build world leaders. We don't want to be owned by companies that will either repatriate headquarters or chop some of our staff or whatever. The world needs more Shopifys where
Health, right? So
Health
started out with 30 million. Now you're at close to 1.5 billion. You're continuing to grow. Canadian success story.
We're hopefully transforming healthcare in Canada in many positive ways and help alleviate some of the pain, but also growing the company, creating jobs, creating great jobs, creating great experiences and all these folks like Research in Motion, even though it hasn't, the story's not done, but it certainly didn't end well. It's not done, but there's a whole bunch of executives that came out of that Magnet Forensics, right? That grew these world-class companies because they saw what world-class meant and looked like. So we need to have those management teams experience what it is to grow 500 million, $1 billion, $2 billion, $5 billion companies, and whether they recycle into a new company, whether they become on the board of these companies, we just need more of that. And if we hit the sell button too soon, we don't get advantage. We got to be. But the problem is, if we don't get the valuation, I get it. The boards, what are they going to do, right? And how do we get investors? And now that it seems like we got to beat them on the head to say, hey, look, these 10 companies just got taken private at valuations 40% higher, or whatever the average would have been. Why aren't we day to day? And these private equities want a great return too. So that tells you how crazy undervalued many of these companies were. I don't have an easy answer to correct that, but we need to try to work together to figure that out. And anyway, folks like you are obviously helping in a big way on exposing these undervalued companies that we have that just need some more love.
It's important, exactly, especially in Canada. So to close out the show, Tom, we'd love to hear what book recommendations you would make for people who want to get into the world of tech investing.
Oh, wow. Geez, there hasn't been. What's been the one that I've read most recently that would help? Oh my gosh, it's not called Think Bigger. There's a marketing related one with software. Sorry, it's not called Think Bigger. It's something like that. I'll look it up after and put it on your chat.
Sure.
But it tells you how software companies need to own this category. So in many cases, we own our category. And now that you start to think about certain areas of healthcare IT, you think of right? Tantalus, in our own way, on grid modernization, there's a piece of that category that we're really going to own. So it's a book about how a number of companies, especially software companies, own their category. And it's not just how the R&D and everything else, but it's also how they marketed it, that they, you basically can't go wrong for buying company X. And that's probably the most recent one where it just how to create moats, but also create the narrative on they're the market leader and carve out your own niche. And a lot of companies I've been involved with have done that, Descartes and everything else. So that's probably the most recent book that I read that was probably, it's not necessarily on that, like how to invest and how to look for return on investment. Look at all these metrics. It's more about, are these companies creating a really good moat and creating their own, where they don't have to be directly price competitive, and it looks like you're the only game in town.
It's almost like a winner-take-all type of pursuit. It reminds me of Peter Thiel's book. I forget the name of the book.
Zero to One?
Zero to One. He talks about the same.
Yeah, and Peter has some political views that are interesting, but that was a really well-defined book. You're absolutely right. That has a lot of the same themes in this book as well, and I did like the Zero to One a lot as well.
Oh, interesting. Well, Tom, thank you very much for your time. We've learned a lot. I wish you all the success with Well Health and Tantalus and the other investments, and thanks again.
Well, thank you for evangelizing the small cap tech market, because we certainly need it. So I appreciate all you do.
Have a good one.
Thank you.